Now starting, all attendees are in listen-only mode.
Good afternoon and welcome to today's webinar, New Business Startup Tips and Traps. My name is Caitlin Motzberg from CCIQ and I'm your facilitator for today. Alongside me, I am delighted to welcome Cheryl Overlack from BDO. Andrea is unable to co-present today due to illness, so Cheryl will be covering the full presentation. Cheryl has over 15 years business consulting experience to SMEs. She has a diverse client base covering a range of small to medium businesses and specializes in accounting and taxation advice for SMEs. This webinar will address key considerations for potential business owners seeking to establish a new business or purchase an existing business. From entrepreneurs to family businesses, this session will benefit anyone considering starting or buying a business regardless of the size. You will be provided with thought-provoking insight into business startups and access to resources that will in turn give you the confidence to make informed decisions about your proposed business venture before taking the plunge. First, some tips to get the most from today's session. We will be online for about 45 minutes, and following the main presentation, there will be an opportunity for questions and answers. Please send your questions through for Cheryl using the text box on screen. Following the session, we will email all participants a copy of the presentation, a link, and additional supporting information, so please check your inbox later today. So now I'll hand over to Cheryl from BDO to take you through today's webinar, New Business Startup Tips and Traps.
Thanks, Caitlin, for your introduction, and welcome everyone today to our webinar. I'm going to hit you with a bit of a stat to start with today. McCrindle research has reported that only half of new businesses survive the first 4 years of operation. This really highlights how critical it is for potential business owners to carefully research, analyse and plan all aspects of their proposed venture prior to investing significant resources into launching a new business. This leads us to the key topic areas which I'll cover with you in today's webinar, which are essentially the key considerations when seeking to establish a new business or purchase an existing business. We'll also look at the process of assessing the feasibility of your proposed venture, which will lead us to the importance of planning for your business. We'll look at key considerations around structuring your business, setting up your accounting systems, and your legislative and regulatory obligations as a business owner. We'll create an awareness of common pitfalls to starting a business, but also how you can potentially avoid these. It's important to realise that business startups can include several different types of scenarios, and therefore the key considerations should be taken into account regardless of the type of startup. Some examples might include a brand new startup, purchasing an existing business, or a franchise. I'll mostly be addressing the requirements for a new startup, but we'll also touch briefly on key considerations in purchasing an existing business. No matter how great or innovative your new business idea, product or service may seem to you, it is important to first determine the viability of your venture before investing significant time and financial resources into it. Not only is this a worthwhile process for you, but any parties with a financial interest in your new business, such as your lending institution or potential investors, will want to know if the venture is expected to be viable and also whether it is expected to yield sufficient returns in the future. This leads us to the question of whether or not you feel you are personally ready to take on the reality and challenges of starting and running a new business. Ask yourself whether you would be willing to sacrifice your personal income and invest any profits back into the business, as this will be something that you might need to do. A question that we always ask clients, and for you to consider, which really puts things into perspective is this new business going to be worthwhile financially, or am I better off going to work for someone else for a wage or salary? There may be times where you more often than not have to sacrifice parts of your personal life to spend time working in and on the business, particularly if you are a sole trader. So ask yourself if you can afford to, and are you willing to sacrifice time with family, friends, potentially your health, give up holidays and recreational activities for the benefit of your business, and for how long are you willing to do this for? A potential business owner needs to be able to weigh up these considerations against the other potential benefits of running a business, such as the flexibility associated with being your own boss, being able to pursue your own goals, doing something you really like and enjoy, as well as the rewards and outcomes that you potentially stand to reap. You'll also need to ask yourself whether you have the required industry skills and experience specific to your business's sector, as well as appropriate business or management experience. If not, is this something that you will be able to realistically learn in time through training and development prior to your business launch? So you've established that you are personally ready to take on a new business venture. So what do you need to look at in determining the feasibility of your new startup? It is crucial to assess the potential of your business concept, products, or services. This is a very broad area, but generally includes conducting market research and testing your idea with your target market or willing family and friends to find out their likes and dislikes of your idea. This could also involve testing your proposed pricing structure with your target customers to reveal the level of price sensitivity. Obtaining endorsements from early adopters of your product or service that you'll be driving through your new business will assist to attract more market followers. Researching successful business models of similar ventures may reveal important lessons and save you time rather than having to reinvent the wheel. Determining the level of demand for your product or service is essential to the viability of your business, because without this, it is unlikely that you will reach the sales targets required for profitability. In order to do this, it is important to not only define your target market, but to also research and obtain a thorough understanding of your target customers. This should include looking at their demographics, needs, behaviours, purchasing patterns, price expectations, and how well your business, product or service aligns with these wants and needs. This research could be performed through desktop research, as well as conducting surveys and interviews with a representative sample of your target market. This research will also assist to determine the potential size of the market, which is critical in establishing the likely uptake of your product or service in the market. Ask yourself if this demand and likely uptake is enough to warrant your time and financial investment in the new business startup. It's essential to identify your likely key competitors and the level of competitive threat they pose to your new business by finding out as much about them as possible. Research their operations, products or services, pricing structure, locations, website, and key personnel. Consider doing a mystery shop of your key competitors. What might their reaction be to you entering the market? From this, identify your business's competitive advantage or advantages over these operators. You will need to ask yourself whether it will be possible for your business to realistically and effectively compete with other operators, products and services and grow its market share based on its competitive advantage. Research the state of the industry that you will be operating in and identify whether there are any significant issues or opportunities that may affect your business operations in the future. Is the industry likely to grow or remain stagnant? These are important questions. Also consider local and global trends in the market and how these may impact on your new business. For example, changes in technology may be highly relevant to the survival of your business. Conducting a comprehensive market analysis for your venture and assessing its operating environment will equip you with useful market knowledge to base key business decisions on. Being able to effectively sell and market your product or service to your target customers is essential to being able to achieve your sales targets for the business to be profitable in the first instance, let alone sustainable in the future. Well-developed and targeted marketing strategies will also be critical in achieving this. It is therefore essential that you or someone in the business has relevant marketing expertise and that you have allowed for sufficient human and financial resources to implement the marketing strategies and actions required to achieve the projected sales figures. If your startup is new to the industry, consider the benefits of growing your contact base through networking, positive word of mouth, and taking advantage of the power of social media. Start with the lower hanging fruit first that are likely to give you the greatest return on investment. In other words, focus your initial marketing efforts on low-cost activities that are likely to generate the most sales or greatest level of customer engagement. As well as your own skills and experience as the business owner, it is important to secure the required type and quantity of human resources to operate your business, especially if your operation is highly reliant on certain technical skills. It is important to assess whether it's worth training staff in these areas or attracting suitably qualified personnel through recruitment to meet your startup business's skills needs. The location of your new business may mean the difference between the success and failure of your startup, depending on the type of business you are operating. Regardless of the industry, a key set of criteria should be developed based on the ideal location for your business and used to assess potential business premises for suitability. Probably the underlying factor in determining the feasibility of a new business is its financial viability. In some instances, a financial assessment of the startup may unfortunately reveal that the proposed venture is not viable, despite the business owner's passion and drive to make a new business or business idea work. There are many questions to be asking yourself in assessing the financial viability of your new startup. Have you made a list of the expected costs for the startup of the business? Are you aware of your capital requirements for the business? At what point is the operation expected to break even? At what point is the business expected to achieve a profit? And what are future levels of profitability expected to look like? Have you developed sales forecasts, and are these realistic and achievable? What are the potential sources of funding for your new business? For example, do you need to access finance, or is there a potential to access government grant funding? You will be able to develop answers to these questions through utilization of financial analysis tools such as financial projections, cash flow forecasts, break-even analysis, sensitivity analysis, and sales forecasts. Depending on the level of financial expertise within your new business, you may need to access the services of your accountant or business advisor to assist with these analyses. Depending on the size of the business, you may wish to consider obtaining professional external support to develop a comprehensive feasibility study or viability assessment for your venture. This will provide you with an objective analysis on the feasibility of the new business idea and is highly recommended, especially for high-risk ventures. While conducting a feasibility assessment may require a small financial investment, consider the value of the exercise compared to launching directly into a new business without doing your homework, only to reach a point much further down the track where you realize that the business is not actually going to be viable to operate. If you have chosen to purchase an existing business, there are additional dimensions which you will need to consider. The vendor or their representative should offer an information memorandum, which should have enough material to conduct due diligence prior to acquisition. A due diligence checks the financial and other records to test that the information received can be relied upon. If an information memorandum is not provided, you should most definitely request this kind of information from the vendor. The importance of preparing a budget plan to determine future profits and balance sheet is imperative, and it is recommended that you seek professional help to assist with the process. It is important to ask yourself whether you know this industry well enough and are you capable of running it. So then we come to the fork in the road. After you have completed your feasibility study, you'll need to decide whether to proceed with the venture or not. Sometimes your idea might need some fine-tuning to make it viable, but remember to be realistic. If the numbers don't add up, be prepared to start all over again or walk away. Once you've determined that your business is viable though, the next step is to develop a business plan. A business plan should annotate all aspects of your proposed operation that are required to achieve your business mission and key goals for the future. The business plan should address all key areas of the business, including operations, market analysis, marketing plan, risk management plan, legal, human resources, and financial. Undertaking a SWOT analysis of the proposed business venture as part of the business plan will assist the business owner to identify how it can maximize its strengths, address its weaknesses, take advantage of opportunities, and mitigate against threats. A comprehensive business plan and set of financial forecasts is often required by financial institutions and grant funding bodies to underpin requests for funding. Therefore, you may consider seeking external professional assistance to develop a quality professional document that will withstand due diligence. In addition to the legal requirements around business structures that I'll address later on, startups also need to ensure they meet their legal obligations under relevant legislation such as the Workplace Health and Safety Act and industrial relations laws. Take, for example, a recent case in Cairns, which saw an employer having to reimburse 19 casual employees almost $65,000 in underpaid wages for the period July 1 last year to February 23 this year. The underpayments were identified after Fair Work inspectors randomly visited the business in October last year and examined wages records. It seems that neither the employer nor the employees were aware of their obligations under the Fair Work Act and specifically under 3 separate modern awards. Certain industries require operators in that particular field to comply with and hold specific licenses, permits and registrations to ensure quality and consistency of services or products. This is something that you might investigate with your relevant industry body. Compliance with local government laws relevant to your startup also need to be considered and taken into account. If your new startup is the vehicle for a new or innovative product, then legislation around intellectual property protection will be highly relevant to protect your product in the market. Ensure your new startup holds the appropriate and required insurance cover so that the business is adequately covered. Ask yourself what external professional resources and expertise is around you that you can access to provide valuable support and accurate advice during the startup process. These would typically include, but are not limited to, your accountant, business advisor, bank manager, insurance broker, legal, industry bodies, and various government departments. You may already have existing relationships with professionals in these fields, or it may be that you need to find contacts and build relationships in certain areas. These working relationships should be enduring and continue throughout the life of your business. If this is your first time starting a business, you might find it useful to find a business mentor who is either particularly good at running a business or has experience and knowledge in your specific industry sector. A mentor should act as a sounding board for ideas, advice, or support. After you've made the decision to embark on your new venture, whether it be a startup or the purchase of an existing business, you need to speak to your accountant. He or she will help you decide on the best structure for your business and will hopefully help you avoid difficulty with regards to income tax, capital gains tax, and accounting in general in the future. Bear in mind that what is best for your business right now might not work so well in the future. However, your accountant should be able to help guide you through the pros and cons of each scenario, and together you can decide on the most appropriate structure. The most common types of trading entities you might consider are sole trader, partnership, discretionary trust, and company, or you might consider a combination of these. If you're a sole trader, business profits are treated as personal income and you pay tax in your own name. Your trading name is your own name unless you choose to use a registered business name. A partnership is not a legal entity from an income tax perspective. Instead, profits are distributed to the partners based on their partnership share. The partnership still needs its own tax file number and is required to lodge an income tax return. It would be beneficial to draw up a partnership agreement with your solicitor, which governs your rights in line with the Partnership Act. A few years back, I did the work for a partnership, which was a partnership of 2 middle-aged fellows who were unrelated. They ran a very successful business, which they had built from the ground up themselves. As they had both been involved from the very beginning, no partnership agreement had ever been formed. Everything in the partnership was split 50-50 and all decisions were made together. Unfortunately, one of the men suffered a massive heart attack and died instantly, aged in his early 50s. Not only had the men never formed a partnership agreement, they had never discussed what would happen to the business should something happen to one of them. Suddenly, the deceased man's wife was a 50% partner, but knew nothing about the business and had no interest in being involved in the business either. The options available to them at that point in time were 1. Continue running the business with the remaining man and the deceased man's wife, or 2. For the remaining man to buy out the share from the deceased's wife. Neither option was particularly satisfying to either party, but after lengthy discussions and very large legal fees, settlement was obtained. The key here is to always be prepared for the unknown and don't leave things until later. This situation could have been avoided with both a partnership agreement and an appropriate buy-sell agreement. A discretionary trust is run by a trustee for the benefit of the trust's beneficiaries. The trustee is responsible for any debts, so this often provides increased assurance for asset protection. A trust deed will need to be drawn up by your solicitor, and this will set out, amongst other information, the trustee and the beneficiaries. For this reason, trusts are more expensive to set up than a partnership or sole trader. Generally, a trust does not pay income tax. Instead, the profits are distributed to the beneficiaries, who then pay tax on the amount distributed to them. However, a trust income tax return is still required to be lodged, and the trust will need a tax file number. A company pays a flat rate of tax. The current rate is 30%, although the government recently announced a reduction to 28.5% for eligible small businesses. The tax on the company's profits is paid by the company. The net amount is then able to be reinvested in the company or paid out to shareholders via a dividend. Companies are more costly to set up and have ongoing annual fees with ASIC. A company is not only required to lodge an income tax return, but they are required to prepare financial statements, which means higher accounting fees. A company needs to be registered with ASIC and will also need its own tax file number. It would also be wise to have a shareholders agreement drawn up with a solicitor. Think of this as your business prenup. A well-drafted shareholders agreement will cover what decisions directors can make, what decisions shareholders can make, dividend payments, and what will happen if any of the shareholders or directors want to exit, amongst other things. There are further considerations with regards to capital gains tax concessions, which should be discussed with your accountant before committing to your chosen business structure. All businesses should obtain an Australian business number or ABN. This can be done online via the ABR website and is free. Without an ABN, your suppliers must generally withhold 49% of any monies they pay to you. In addition, if your turnover or income is greater than $75,000 in 1 year, you are required to register for GST. You will then need to report your GST collected and GST paid on a business activity statement to the ATO, either monthly, quarterly, or annually, depending on the size of your business. Additionally, if you plan on employing staff, your business will need to register for PAYG withholding. You will need to ensure each employee completes a TFN declaration. And don't forget, you will need to pay superannuation of 9.5% on the gross wages for your employees. Once your business is up and running, consider the type of bookkeeping system you are going to use. There is more variety than ever before when it comes to bookkeeping systems, so don't be afraid to talk to your accountant about which one would best suit your needs. Gone are the days of keeping your receipts in a shoebox and taking them into your accountant at the end of the financial year. Savvy business owners stay on top of their finances and don't turn a blind eye to areas of concern. The easiest way to keep track of how the business is going is with a computerized bookkeeping system. A common example of this would be MYOB. More recently, though, cloud accounting has become increasingly popular. A system such as Xero or MYOB Live allows you to feed your bank account straight into your bookkeeping software, and view up-to-date financial information at the touch of a button. The advantages of cloud accounting are numerous and include web-based access on a variety of platforms, no more having to log in on your PC and take backups. You can give other users access and you can access the file at the same time. This can be particularly useful if you require assistance from your accountant. Transactions can be pre-coded, again saving time and effort with regards to data entry. Receipts can be uploaded and stored electronically within the file, meaning less paper in your office. Invoices and payments can be prepared and authorised on the run. I'll give you an example of a client who has only recently come to me. They're a sporting association and they are by no means a large organisation. Historically, the treasurers have been non-accountants. About 15 years ago, the treasurer at that time set up a bookkeeping system using Excel. These spreadsheets were used to record all incomings and outgoings and then flowed into a set of financial statements. This was a great basis for non-accountants to enter data, but failed to show an accurate picture of the financial situation of the association at any given point in time. Monthly meetings meant that the treasurer spent time preparing financial reports and outlining the financial position. When I started doing the accounting work, I advised them to consider switching to Xero. The current committee were very open to the idea, so I set up Xero for them through our office. Now, the treasurer reconciles the Xero file daily using the live feeds that come through from the bank. All committee members have access to the Xero file and can see invoices owing both to them and by them. Members who owe money can be given an up-to-date statement at any given time. Invoices can be issued with the push of a button and emailed directly. The time saving for the treasurer has been immense, and the work for the accountant at the end of the financial year will be greatly reduced. There are many more advantages to cloud accounting, and it would be worth your while to speak to your accountant to discuss the options available to you and how you might be able to save time and money. And finally, I'd like to leave you with a checklist of tips and traps. Speak to your accountant, your solicitor, your business advisor, and your banker before you commit to starting your business. It may cost you more upfront, but it could potentially save you thousands of dollars or more down the track. Ensure you are clear on your direction, vision, and goals. Ask yourself what you want to achieve in 12 months, 2 years, and 5 years' time. There is no such thing as too much planning. We've all heard the old saying, failing to plan is planning to fail. Don't let this happen to you. Do your research and be confident in what you are going to do. Timing is everything. A poorly timed entry into the market can be extremely detrimental. Research the market and ensure that you get the timing right. Don't overcommit yourself financially. Ensure you always have enough money left to cover your ongoing commitments. Set up a bank account that is used solely for the business. This will help you keep track of your expenses and you will easily be able to see how much money you have at any given time. Do what feels right to you. You can receive the most well-meaning advice from a variety of professionals, but ultimately, the business is yours and you shouldn't be forced into doing something you're not comfortable doing. Don't be afraid to voice your concerns and ask questions of anyone and everyone. Don't place too much reliance on credit, either via unpaid creditors or too much debt. Ensure you have enough cash to stay on top of both your creditor payments and your loan repayments. Learn to monitor your cash flow. You need to ensure you will have enough money in the bank account to meet your financial commitments. Make sure your customers are paying your invoices on time. Get your costings right. Ensure that the selling price of your goods and services factors in the costs of your overheads, and don't be afraid to charge for your own time and expertise. Prepare a budget and monitor it carefully. If there are variances, ask yourself why, as this may be an indicator that something needs to change. Measure the business's performance as you go along. Tweak what needs to be tweaked, but don't leave it too long. Learn how to read your financial reports and don't just look at them once a year. Ultimately though, don't be afraid to cut your losses. If things aren't tracking well, don't dig yourself in deeper. Speak to your banker and your accountant about your options, and if things don't improve, it might be that you need to put everything on hold until the timing is better. Thanks everyone for your time today. Whilst this has been a fairly brief overview only, I hope that I've been able to provide you with a sound platform from which to start your journey into business. For now though, I'll hand back to Caitlin for our Q&A session.
Thanks, Cheryl, for an informative presentation. It is now time for our Q&A session, so please send through your questions for Cheryl using the text box on screen, and we will answer as many as we can in the remaining minutes. Okay, I've got one that's come through. How will the $20,000 asset write-off announced in this year's federal budget help me?
This is a really common question that we've been receiving lately, actually, from a variety of different people. So the $20,000 asset write-off announced in the budget this year was one of a number of measures announced that could assist small businesses. The $20,000 asset write-off is only for businesses with a turnover of less than $2 million, which is what the government classifies as a small business. Basically, the write-off allows the business an immediate deduction for assets which cost less than $20,000 exclusive of GST. So that's after you claim back your GST credits. Some examples of the type of assets that we would commonly see would be cars, machinery, office equipment such as computers, telephone systems, copiers. Note that the specific examples given do not include any items that form the cost of a building, for example, built-in cabinetry and shelving. On that note, it's also important to raise another announcement that was made in the budget, which will be specifically applicable today, and that's the immediate deductibility of professional expenses when starting up your business. Some examples would be legal and accounting advice on the setup of the business, and also the costs incurred in establishing a company, a trust, or a partnership. Historically, these fees have been deducted over 5 years, but have been made available as an outright deduction in the hope to promote cash flow within the business.
Thanks, Cheryl. How do I know which version of MYOB or Zero is the right one for me?
This is a really common question, another one that we get a lot. There are a number of versions of both MYOB and Zero, and they all come with different pros and cons as well as differing price tags. Obviously, it does depend on the needs of your business. A small business with only a few transactions, no employees, they'd get away with one of the basic versions of MYOB or Zero. But obviously, a larger business with a significant number of transactions, multiple bank accounts, employees, that type of business, they would need a higher level of software. It's also important to remember that what might be right for your business now might not necessarily be best for your business in the future. So consider upgrading to a higher level package now to save you having to change over in the future. Another consideration when you're looking at which version is the availability of the software by your accountant and your bookkeeper. Some accountants and bookkeepers may have a preference as to which type of software they use and specifically which type of version or which version of that software. So that can create efficiencies within your business. Ultimately, it is best to speak to your accountant and your bookkeeper. Not only will they be able to help you make the decision on which product is best for you, but more often than not, they might be able to provide you with the product at a competitive price.
Thanks, Cheryl. I'm considering setting up a new business that is part of a franchise. What should I be looking out for?
Yes, franchises can traditionally be a little bit tricky. Franchises are often, purchasing a franchise is a strict and structured process more often than not. So the information that I've covered today does apply to the purchase of a franchise, but there are a couple of additional things that you would need to consider. Generally, there would be a franchise agreement which you would have reviewed by your solicitor. This would cover things such as franchise fees and which costs will be covered by the franchisor. Sometimes a franchisor will cover the cost of a fit out of your premises and certain types of marketing and advertising. It is important to know though upfront what you'll be responsible for and what the franchisor will be responsible for and how much you'll be required to pay in fees each year. Some franchises go further and stipulate things such as where you'll need to be located and what type of entity you'd be required to run the business through. And I've even seen ones where they stipulate the type of bookkeeping software you'll need to maintain, and they'll even give you a chart of accounts within that you need to follow. So it is very important to review the contract and franchise agreement in detail.
Thanks, Cheryl. Thanks, Cheryl. That's all the time we have for questions today. I can forward on the remaining questions onto Cheryl after the webinar. On behalf of CCIQ, I'd like to thank Cheryl from BDO for taking the time to present today. I'd also like to thank everyone who has joined us for today's session. If you have any further questions for Cheryl, you can contact her using the information on screen. Don't forget that CCIQ has a range of webinars and events coming up over the next month or so, including Staying Relevant in the Information Age, tomorrow, the 23rd of July, and Choosing 3D Printing for Your Business on the 24th of July. If you want to find out more about the upcoming webinars, you can go to the CCIQ events page to book your place. Thanks for joining us today. My name is Caitlin Mutzelberg from CCIQ, and I look forward to welcoming you to another CCIQ webinar in the very near future.